Hi, I'm Susan Shoemaker at Riggs Asset Management. I'm here with Bob Graham, and we were talking about the debt ceiling and the possible government shutdown that's gotten a lot of attention in the news. And I'd like to know your perspective.
Well, Susan, as you know, we were talking about this today in our investment meeting. And so we went back and we looked at the history of government shutdowns. And I know going into this with all the discord right now we have in Washington, and it's going to be a big deal in the press. There's going to be talking heads on one side or talking heads on the other side. And they're going to be saying how this is the worst thing that's ever happened in the history of mankind. And it may seem that way, but when we go back and look at the history, we find out that, quite frankly, the effects are kind of muted. Let's look at the economy. We've had 22 times where the government even shut down for, let's say, 24 hours or as much as 35 days. And the economic outcomes have been really muted, really has no effect. And I think that's because most people understand that eventually the government's going to reopen. Eventually they're going to write everyone a check.
Right.
They're not going to stop paying Social Security payments to retirees. So it's sort of the normal course of business. Whatever lull you get going into it, you get a little boost at the back end. To the bond market, when we look at that, it's kind of interesting. You would think that, oh my gosh, the government's going to shut down, so what happens is people are going to get rid of government bonds. But it's the exact opposite. People move towards the safety of treasuries. They move because, quite frankly, in the world today and for a long time, the safest investment, quite frankly, ever has been treasury bonds. And so then what happens to the stock market? Well, a recent study put out by Morgan Stanley said that the average return on the stock market was about 4.4%. That is, say it went up in value. It's not to say it didn't pull back because people are concerned going into the government shutdown, but coming out and through that process, stocks, equities actually did fairly well. So when we look at this, I think it's a concern. I think as an American, these types of things bother me. But from an investor, from our perspective, taking care of our clients' wealth, it can provide some opportunities, but they tend to be sort of non-events. A lot of news, a lot of bluster, but at the end of the day, not any real long-term effects to the U.S. economy or to the markets.
And that's important because we're really looking at our objectives over a longer time horizon and not just to that deadline.
That's exactly right, Susan. It's, where are we going to be in 5 years? Where are we going to be in 10 years? And this is a blip.
Great. Thanks so much.